One night, the glow of the trading screen filled the dark room like a cruel spotlight. My eyes were bloodshot from endless analysis, charts stacked like towers of conviction in my mind. Gold surged upward, candles racing skyward like a tidal wave about to swallow everything. My pulse quickened, sweat gathered on my temples, and the mouse felt heavy in my hand. I hit buy, certain I was on the edge of fortune. For a fleeting moment, profit flashed green across the screen, and adrenaline whispered, "You were right." But minutes later, the market turned savage. Price reversed with ruthless violence. My stop-loss cracked like thin glass. Balance gone. Hope gone. I slumped forward, forehead pressed to the desk, whispering into the silence, "Where did I go wrong?" My analysis was perfect. Then I heard a quiet laugh beside me. A man I respected, a seasoned millionaire trader, leaned back in his chair, calm in the chaos that had crushed me. He said softly, "You were right about the trend, but wrong about the timing. And that's what killed you." The words landed like a hammer blow. For years, I thought success meant mastering more indicators, memorizing books, refining analysis until flawless. But the brutal truth cut through me. It wasn't knowledge I lacked. It was patience. Patience to wait for the precise moment. The market itself is never wrong. Only the trader chooses the wrong time. That night, one line redrew my destiny. Welcome to Trading Psychology Stick. This is where the story begins. Right direction, wrong time. Before we go any further, let me be absolutely clear. What you are about to hear is not financial advice. This is not a get-rich scheme or a secret formula that guarantees wealth. These lessons are drawn from real experiences, hard-won scars, and the timeless psychology of trading. Your results will never depend solely on knowledge or charts. They will depend entirely on your discipline, your patience, and your ability to act with control when the pressure rises. Over the next 67 minutes, you'll walk through 15 powerful lessons. Principles distilled from legendary traders like Jesse Livermore, Mark Douglas, Tudor Jones, and Linda Raschke. These ideas reveal why timing, not just analysis, separates those who survive from those who vanish. If you stay with me until the end, you'll carry away a framework that can keep you from being prey to the market and help you finally step into mastery. Have you ever felt the sting of being right about the market and still walking away with a loss? It's the cruelest paradox every trader eventually faces. You call the direction correctly, you see the trend forming, you hit buy or sell with conviction, only to watch the price whip against you and drain your account. That's the silent curse of trading. You can be right about where the market is heading, but if you're wrong about the timing, you still bleed. Most traders believe knowledge is their shield. They spend years collecting indicators, mastering chart patterns, or even analyzing global macro trends. But the truth is ruthless. The market doesn't punish ignorance nearly as harshly as it punishes impatience. You can study endlessly, but if you mistime your entry, the market doesn't care how smart you are. It will still take your money. Timing is the invisible assassin. It hides inside every candle, every setup, waiting for the impulsive hand that fires too early or too late. Picture yourself as an archer, bow drawn tight, aiming at a moving target. Even if you're the best marksman alive, if you release a fraction of a second too soon or too late, the arrow misses. Trading is no different. Precision of direction means nothing without precision of timing. Jesse Livermore, one of the greats, learned this lesson the hard way. Early in his career, he had an extraordinary gift for spotting trends. He could see bull markets forming before anyone else, but he also had a fatal flaw. He jumped in too early. He would pile into a position, convinced he had found the opportunity of a lifetime, only to watch prices dip just enough to wipe him out before the big move truly began. Time after time, he was right about direction, but wrong about the moment. It nearly ruined him until he discovered the discipline of waiting. Livermore once admitted, "It was never my thinking that made me the big money. It was always my sitting, waiting, allowing the market to prove itself before committing." That shift turned him from a gambler into a legend. Imagine him pacing his office, cigarette smoke swirling through the air, charts spread across his desk. He feels the adrenaline urging him to act, his instincts screaming that the stock is ready to run. But this time, he waits. Hours pass, the market shakes out the impatient, price dips and churns before finally coiling and springing upward with force. Only then does he step in, and this time, he rides the wave instead of drowning beneath it. The difference wasn't knowledge, it was timing. And that's the brutal truth. Being right is meaningless if you're early. In trading, being early is just another form of being wrong. The market doesn't reward predictions. It rewards synchronization. When your action aligns with the rhythm of price, trading feels effortless. But when you fight the rhythm, even the right direction feels like quicksand. So, let me ask you, how many times have you nailed the trend only to lose money because you acted too soon? What if, from this moment on, you paused before pressing the button? What if you waited for confirmation instead of chasing the first hint of movement? Take 5 seconds right now and think back to your last impulsive trade. That's the enemy we are fighting, not the market, but our own impatience. This is why the curse of being right but losing is such a dangerous trap. It convinces traders they are skilled because they see the direction, yet it slowly drains them because they never master the moment. The market doesn't care about your prediction. It only cares whether you can align your decision with its timing. And until you do, being right will continue to feel like losing. The market is not a friendly classroom. It is a battlefield, vast and merciless, where every tick is a skirmish and every candle is a clash between buyers and sellers. To step onto this field without strategy is to march straight into chaos. Many traders imagine themselves as generals directing the fight, but the truth is humbling. You are not the general. You are a student of the battlefield, learning to move in rhythm with forces far larger than yourself. On this battlefield, spotting the enemy's weakness isn't enough. Victory depends on the precise moment you strike. Attack too soon, and you charge headlong into an ambush. Attack too late, and the opportunity vanishes like smoke. In trading, seconds separate triumph from disaster. Tudor Jones, one of the great market warriors, summarized it bluntly. The most important rule is not about being right or wrong, but about when you're right and when you're wrong. That one word, when, contains the essence of survival. Let me paint 2 pictures of traders walking the same battlefield. The first is a rookie, hungry for glory. He spots gold rallying. The formation looks perfect. Momentum is building, and every instinct screams, "Attack now!" Like a soldier breaking cover too soon, he charges in. For a brief moment, victory seems certain. Green numbers flash on his screen. His chest tightens with adrenaline. But the market suddenly counterattacks. Price reverses violently, and in seconds his gains vanish, his account wounded, his confidence shattered. He was right about the direction, but wrong about the timing, and that was enough to destroy him. Now observe the veteran. She stands on the same battlefield, studying the same setup. But instead of charging instantly, she waits. She notes how volume builds, how resistance weakens, how the session shifts as London gives way to New York. She senses the moment when the market's defenses finally collapse. Only then does she act. Her entry feels effortless, as if the current itself is carrying her forward. She is not forcing the market, she is flowing with it. The difference is patience, tactical patience, honed through scars and discipline. Every trend has its ambushes, false breakouts, fake reversals, seductive traps designed to lure the impulsive. These aren't accidents. They exist to strip the reckless of their capital and transfer it to the patient. The market doesn't test your knowledge as much as it tests your restraint. Can you stand still when every fiber of your body urges you to act? Can you hold back when the temptation is at its peak? That is the true exam of the battlefield. Picture yourself as a soldier in the fog of war. You see the enemy shift, you think you spot weakness, but charging now may mean running into a trap. What if instead you count to 10? If the opportunity remains after those 10 seconds, it might be real. If it vanishes, you've just avoided an ambush that would have cost you dearly. Trading as battle isn't about fighting harder, it's about fighting smarter. The rookies exhaust themselves in constant skirmishes, chasing every flicker of movement. The veterans conserve their energy, protecting their capital like precious ammunition, waiting for the decisive strike. Victory belongs not to the most aggressive, but to the most disciplined. The battlefield is cruel, but it is also fair. It rewards those who wait for alignment and punishes those who lunge without patience. So ask yourself honestly, how many times have you been that rookie soldier seduced by the first signal of weakness, only to find yourself surrounded when the formation collapsed? How many times has your impatience turned a promising setup into a humiliating defeat? The battlefield never lies. It simply mirrors your discipline or your lack of it. And until you master patience in the fog of war, you will remain just another casualty in the endless conflict called trading. A candle that hasn't closed is like a liar in a courtroom. It testifies one story with passion, only to reverse its words at the very last second. On your chart, it can surge upward like a rocket, green and glowing, whispering promises of victory. But just before the close, it can collapse, shrinking into weakness or even flipping red. That one deceit has ruined countless traders. They mistake possibility for proof, probability for certainty. The market punishes those who act on incomplete testimony. Here's the brutal law. No candle close, no trade. It sounds simple, almost too simple. Yet this rule separates gamblers from disciplined professionals. Consider Daniel Reyes late at night, eyes locked on a 1-hour chart. The candle is long and green, stretching like a tower. His pulse races, his hand hovers over the buy button. He imagines himself catching the start of a powerful trend. For a few minutes, his account rewards him. Numbers flash green, dopamine floods his mind, and the illusion feels real. But as the final seconds tick down, sellers flood in. The mighty candle shrinks, hesitates, and collapses into red. His profit vanishes, his stop-loss hits, and once again he is cast out of the market. One open candle, one deception, one costly mistake. Now, picture another trader, Elena Marquez, scarred by years of such tricks. She sees the same candle surging, feels the same adrenaline urging her to act, but she whispers to herself, "Not yet." She waits. The candle wavers, collapses, and closes red. Now the verdict is clear. Sellers have seized control. By waiting, she saved herself from a false signal. And when the next candle confirms the shift, she enters with precision, aligned with truth rather than illusion. That tiny act of restraint makes all the difference between being prey and becoming a professional. This law is more than technical. It's psychological. The open candle is a test. It asks, can you resist the temptation of incomplete information? The majority fail. They press buy or sell too soon, feeding the patient professionals who wait for clarity. Every early entry is capital donated to those with discipline. And here lies the deeper wisdom. Not all candle closes carry equal weight. Some occur during sleepy hours when the market drifts like a quiet river. Others strike during the golden hours when volume explodes and institutional money roars across the battlefield. To confuse the two is to mistake a whisper for a battle cry. Professionals know the difference. They don't just wait for a candle to close, they wait for it to close when it matters. So write this rule on your trading desk. No candle close, no trade. Whisper it to yourself when temptation burns. Remember Daniel, who rushed, and Elena, who waited. One was deceived, the other preserved. One traded probability, the other demanded confirmation. In the end, the market rewards not the smartest, but the most patient. The market has its own rhythm, a daily heartbeat as predictable as sunrise and sunset. Some hours drift by like a sleepy afternoon, where candles barely move, volume trickles, and the charts feel lifeless. Other hours erupt with explosive force, where fortunes can rise or fall in minutes. These aren't random. They are patterns etched into the global flow of capital, and within them lie the golden hours of trading, the moments when institutional money surges into the market and reveals its true intention. Imagine trading during the Asian session. The charts hum quietly, a low whisper in the night. Prices inch back and forth in narrow ranges. To the untrained eye, it looks like opportunity. Tiny movements that mimic trends. But these are shadows, lures for the impatient. Countless beginners lose themselves here, chasing scraps of motion in a barren desert. Then London opens. It's as if a sleeping giant wakes. Suddenly, the silence is shattered. Candles stretch, volume surges, and real trends begin to form. The energy is palpable. A roar compared to Asia's whisper. And finally, when New York joins, the full orchestra plays. Liquidity explodes, momentum surges, and the market's verdict becomes clear. It's during these hours, not the quiet ones, that the professionals strike. Take the story of Marco, a trader who burned through 3 accounts trading exclusively at night during Asia. He stayed awake, red-eyed, staring at 5-pip moves, convinced that meaning hid inside them. But it was exhaustion he found, not profit. Only when he restricted himself to London and New York opens did his results transform. Same trader, same system, different hours. His win rate soared, not because he suddenly grew smarter, but because he finally aligned with institutional flow. Linda Raschke, one of the greats, once revealed that she needed only 2 or 3 hours of focused trading each day to make her entire year. Not days of endless staring, not 24-hour hunts for scraps, just golden hours when real money moved. That's the hidden truth. Professionals don't fight the tide. They wait for it. Picture the daily cycle as a stage play. Asia whispers quietly, setting the scene. Europe builds the narrative, laying foundations of momentum. America delivers the verdict, the climax of the show. Each session has a role, but not all roles carry profit. If you try to wrestle money out of the wrong session, you're not trading. You're fighting against nature's rhythm. So ask yourself, how many nights have you sat awake, forcing trades in silence, only to wake exhausted with a smaller account? What if you compressed your energy into 4 to 6 golden hours instead? What if you stopped fishing in swimming pools and cast your line where the rivers flood with fish? Here's your challenge. For 1 week, trade only the London and New York Opens. Record every result. Feel the difference in momentum, clarity, and direction. You'll discover what veterans already know, that timing isn't just about when to enter a trade, but when the market itself is alive. A candle is never just a bar of red or green. It's a fingerprint of psychology, a tiny battlefield where fear and greed leave their mark. Each wick whispers of rejection, each body shouts who held control, and each close delivers the final verdict. But here's the catch. Those signals mean nothing without time. A pin bar at 2 in the morning in Tokyo is a whisper few will ever hear. That same pin bar at New York Open is a shout that shakes the floor. Time doesn't just frame the story. It decides if anyone is listening. This is the great trap for traders who worship patterns in isolation. They memorize engulfings, hammers, and pin bars, believing the shape alone is a signal. But without context, they are incomplete sentences. The same pattern can be a mirage or a miracle, depending on when it appears. That's the truth the untrained eye misses and the professionals never forget. Picture two traders on opposite sides of the world. In Asia, a novice named Raphael stares at his chart. A perfect pin bar forms at support, glowing like a beacon. He feels the rush. This must be the reversal. He enters, his hopes riding on the wick. Minutes pass. Price drifts sideways, then bleeds lower. The pin bar dissolves into disappointment, a trap born of silence. Across the globe, Elena waits for New York's opening bell. Volume surges, volatility roars, and a pin bar prints at the same kind of support. This time, the reaction is instant. Price rockets upward, carrying disciplined traders with it. Two identical patterns, two opposite outcomes. The difference wasn't the candle, it was the clock. That lesson struck me hardest when my mentor, Daniel Reyes, showed me two charts side by side. Each displayed the same candle, but one was Asian session and the other London Open. The candle is the messenger, he said softly, but time decides if anyone is listening. That single line burned into my brain. Since then, I've never looked at price action without asking, when did this happen? And who was watching? This is the time context principle. A hammer pattern after news isn't just a hammer. It's the footprint of thousands repositioning. The same hammer during pre-market doldrums is nothing more than noise. Professionals don't just ask what the candle says, they ask when it speaks and who's listening. They filter every pattern through this lens. So ask yourself, how many setups have you taken simply because the pattern looked right while ignoring the clock? How many failures weren't the pattern's fault at all, but your blindness to timing? From this moment, add a filter to your trading. Only act on patterns that appear during your proven golden hours. Track 20 trades with this rule, then 20 without. The difference will not just surprise you, it will shock you. There is no moment more violent in trading than when major news strikes the market. Non-farm payrolls, CPI releases, central bank statements. These announcements land like thunderbolts, splitting the calm of the charts into chaos. In an instant, candles erupt, leaping 50 pips upward, collapsing 100 down, then reversing again before you can catch your breath. For the unprepared, this is not opportunity. It's a wood chipper that chews through accounts with merciless speed. The truth is simple, but ignored. News does not create clarity. It creates confusion. George Soros once explained that markets live in constant flux, and profit comes not from the obvious, but from the unexpected. News doesn't reflect rational thought. It reflects raw emotion, fear, greed, desperation, compressed into seconds of madness. If you try to predict or preempt that storm, you become its first casualty. Picture a trader named Victor sitting nervously before non-farm payrolls. His charts are clean, his analysis detailed. He's convinced the numbers will disappoint, so 60 seconds before release, he clicks sell. The countdown runs. 3, 2, 1, release. The market explodes upward, slicing through his stop-loss instantly. Before he can blink, it crashes violently down, then whipsaws back up, turning his screen into a blur of red. His capital evaporates in seconds. He wasn't destroyed by the numbers. He was destroyed by his need to gamble on chaos. Now, picture Sophia, seated calmly at her desk during the same event. She doesn't touch her mouse. She doesn't place a single order. She lets the market scream, watches it thrash, notes how stops are hunted in both directions. She observes, like a scientist watching a storm through glass. Then, after the frenzy fades, a powerful hourly candle closes. The direction is clear. Only then does she enter, aligned with the crowd that survived. The storm carries her profit instead of wrecking her ship. This is the news principle. The market doesn't care about the news itself. It cares how traders react to it. That's why professionals never trade the announcement, only the aftermath. They know the first 5 minutes are a slaughterhouse, designed to eliminate the overeager. The real opportunity isn't in predicting the lightning strike, but in sailing when the sky clears. So reflect on your own history. How many times have you gambled before a release, certain you knew the outcome, only to be punished no matter what? What if you adopted a new law? No trades 30 minutes before and at least 5 minutes after major news. Tomorrow, when the headlines hit, resist the urge. Don't trade the blast. Watch it, study it, learn from it. Take notes like a scientist. You will learn more from observing a single news event than from losing money in 10. The chaos isn't your enemy. Your impatience is. Sometimes the most profitable trade is the one you never take. This truth feels like a paradox, but every veteran knows it well. The market is a minefield of traps, false signals, and noise engineered to lure the impatient. Rookies step on every mine. Masters map the field and wait. Restraint is not weakness. It is a position, as powerful as any buy or sell. When you choose not to act, you are actively protecting capital, preserving clarity, and conserving energy for the right moment. Ed Seykota once said, "Good trading is boring." That wasn't cynicism, it was wisdom. He meant that professionals spend more time doing nothing than anything else. They don't chase scraps of opportunity in choppy conditions. They don't lower their standards when the market grows quiet. Instead, they sit still, watching, sometimes for hours, until the conditions align perfectly. What looks like inactivity is actually discipline in its purest form. Picture this. A trader stares at the screen during the midday lull. The market drifts sideways, volume is thin, and every breakout collapses into a fake-out. His fingers itch. Maybe I can scalp something, he tells himself. He clicks buy. Within minutes, the price snaps back, hitting his stop. Frustrated, he doubles down, desperate to recover. The market punishes him again. By the end of the session, he's drained, both financially and emotionally, because he couldn't do the hardest thing. Nothing. Now, picture another trader. She sees the same conditions, but she names them clearly. Low volume, no clear direction, a no trade zone. She writes it in her journal, staying out. Then she steps away, preserving her focus. Hours later, when the U.S. afternoon session awakens with real movement, she returns fresh and alert. She takes one clean trade with momentum behind it. That single move pays her for the entire day. The difference wasn't knowledge. It was the ability to wait. This is the staying out principle. Markets reward patience and punish compulsion. Every bad trade you've ever taken was born from the fear of missing out, from the discomfort of silence. But silence is where professionals gather strength. Silence builds clarity. Think of a sniper waiting for hours in the tall grass for one perfect shot. That's trading done right. Rare, deliberate, and decisive. Here's a test for you. Before the next session begins, write down the maximum number of trades you will take. Keep it small, say 2. No matter what happens after those 2 trades, you stop. This simple constraint will sharpen your eye. You'll start to select only the cleanest setups because you know your ammunition is limited. The fewer bullets you fire, the more precise you become. So ask yourself, how many times has doing nothing saved you money? And how many times has impatience cost you dearly? The difference between failure and mastery isn't more trades, it's fewer. It's waiting for the right moment while everyone else gets chopped to pieces in the noise. The market will always tempt you with shadows. But the trader who can stay out when conditions are wrong becomes the one ready when the real opportunity finally appears. Most traders believe the secret to survival is winning more often. They obsess over accuracy, trying to push their win rate to 70%, 80%, even 90%. But here's the brutal truth. Accuracy is irrelevant without mathematics. You can win 8 out of 10 trades and still blow up your account if your losses are enormous and your wins are tiny. On the other hand, you can lose more trades than you win and still build wealth if your risk and reward are asymmetrical. This is the difference between gamblers and professionals. A trade is never just a prediction. It's a probability equation, and the only part of that equation you fully control is how much you risk versus how much you stand to gain. Professionals don't obsess over being right. They obsess over asymmetry. They want to risk 1 to make 3. They want to lose small and win big. It sounds simple, but it's the line that separates survival from ruin. Take Jesse Livermore. Early in his career, he'd bet everything on conviction alone. His timing and analysis could be flawless, but when he was wrong, he was wiped out. Bankruptcy taught him the lesson. It wasn't about always being right. It was about structuring trades so the wins dwarfed the losses. That shift in mathematics turned him from reckless gambler to market legend. Picture this. A trader risks $100 to gain $300. He loses 3 times in a row, down $300. On the 4th trade, he wins and he's back to break even. On the 5th, another win. He's now profitable, despite being wrong most of the time. That's the power of asymmetric risk. Losing more often than you win, but still building wealth. Now picture the opposite. A trader risks $500 to make just $100. He wins 3 trades in a row. Great, he's up $300. But then, one loss wipes out all of it and more. Net result, negative. He was right 75% of the time, but his account shrank. The problem wasn't skill. It was mathematics. The revelation is this. Proper ratios aren't just numbers. They're freedom. They allow you to embrace losing streaks without despair because you know one winner can make it back. They give you confidence to follow your plan without fear. Tudor Jones once said, "Don't focus on making money. Focus on protecting what you have." He understood the math. When you defend the downside, the upside takes care of itself. So here's your challenge. Look back at your last 20 trades. Calculate your average win versus your average loss. If the ratio is less than 2 to 1, you're playing a losing game, even if you feel like you're winning. Starting tomorrow, adopt this rule. No trade unless the potential reward is at least twice the risk. It will feel like you're trading less, but in reality, you'll be trading smarter. The numbers won't just protect you, they'll carry you to survival. In the wild, the apex predator doesn't waste energy chasing every shadow. A lion doesn't lunge at every gazelle that darts across the savannah. It studies, waits, conserves strength, and when the moment is perfect, when the prey is slow, isolated, vulnerable, it explodes with terrifying precision. The hunt ends in seconds, almost inevitable. Trading follows the same law. Amateurs dart at every flicker of movement, exhausting their capital and spirit. They chase noise, pile into mediocre setups, and bleed slowly to death. Professionals, in contrast, are predators. They sit still through the boredom, through the endless waves of false signals. They wait, patient and unshaken, for the rare opportunity that checks every box. Then they strike with clarity, sizing decisively, and ride the wave with calm confidence. Imagine the market as a vast savanna at dawn. Thousands of traders scatter like frightened herds at every rumor or micro move. The grass sways, dust rises, and the chaos feels endless. Somewhere in that chaos, the predator crouches, motionless. He ignores the panic. He ignores the herd. His eyes are locked on one perfect setup. Hours pass, even days. And then, in an instant, he strikes. No hesitation, no second guessing. The move is clean, decisive, and profitable. This predator mentality separates survival from mastery. You don't need 100 trades a week. You don't even need 10. A handful of precision strikes each month can build an entire career. But here's the paradox. The less you trade, the more you must wait. And waiting tests discipline harder than any loss. Most traders collapse under silence, desperate for action, until their capital leaks away in scraps. The apex trader thrives in silence because he knows patience is profit in disguise. Consider news events. The herd gambles before the release, charging blindly into chaos. Most are slaughtered. The predator waits. He lets the explosion rip through stops, lets emotions burn out. Then, when the dust clears, when the candle closes and direction reveals itself, he pounces. The win feels effortless, but it was forged by hours of discipline. Here's your challenge. For one full week, take only one trade per day, and only if it's your absolute best setup. Not good enough, not almost right, the best. Journal the experience. You'll discover how clarity sharpens when action is scarce. You'll feel the power of waiting like a predator, and you'll realize that the path to mastery isn't trading more, it's hunting less and striking with precision. Discipline is the fortress every trader dreams of, but few ever build. Without it, freedom is an illusion. You imagine liberty, working from anywhere, no boss, your destiny in your hands. But in truth, without discipline, you're chained to impulses. Every tick tugs your emotions. Every loss stabs your confidence. Every win tempts you into recklessness. Freedom without discipline is a prison in disguise. Rules are not suggestions. They are the stone walls of your fortress. A fortress isn't built in a day. It's brick by brick, habit by habit, until nothing can break you. Most traders sketch their rules in their minds, but when the storm comes, those rules crumble like sandcastles. Only written, enforced laws survive the flood. Mark Douglas warned, "One undisciplined trade won't destroy you, but the pattern of breaking rules will." That pattern is acid, eating through accounts, dreams, and hope. Picture this. A trader tapes 3 rules on his monitor. Max 3 trades per day, risk 2% max, stop after 2 consecutive losses. The first 2 trades hit stops. His chest burns with frustration. Revenge whispers, "One more. You'll get it back." His hand trembles over the mouse. This is the test. If he clicks, the fortress collapses. If he walks away, the fortress stands. In that single choice lies his fate, not profit or loss, but survival or ruin. Now imagine another trader, scarred by past collapses. She built her fortress brick by brick, rules written, visible, absolute. She hits 2 losses, sighs, shuts the platform. She journals instead of trading. The market rages, tempts, screams, but her fortress holds. Capital intact, psychology intact, discipline preserved. That fortress is not rigidity. It is protection. She is free because she obeys her own laws. The principle is simple. Without a fortress, the market invades. With it, you withstand storms. Every time you follow your rules, especially when it hurts, you strengthen your walls. Discipline is not punishment. It is armor. Tomorrow, test yourself. Write 3 unbreakable rules, post them where you trade, and obey them for 1 day. If you succeed, you'll glimpse the power of your fortress. If you fail, you'll glimpse why most traders never last. A trader without a system is like a ship drifting in stormy seas without compass or anchor. Each wave of greed or fear pushes them in a new direction, until eventually the rocks claim their vessel. Many beginners believe instinct or luck will carry them, but luck runs out, and instinct betrays when emotions are high. A true trader doesn't trust the currents. He builds laws carved in stone to steer his craft no matter the storm. These laws are not soft guidelines, not motivational phrases. They are hard written rules, your constitution. Without them, the market will test you. Find your weakness and exploit it. Jesse Livermore filled notebooks with the lessons that cost him fortunes. Mark Douglas reminded us that consistency doesn't come from predicting the market, but from following rules without exception. Your laws protect you not just from the market, but from yourself. Imagine the contrast. One morning, a novice trader wakes up, scans charts, and feels today is a long day. He buys impulsively. Price rises for a moment, then collapses. He panics, closes at a loss. Minutes later, he jumps into another setup that looks good. By lunchtime, he's down 3 trades, exhausted and frustrated. His equity curve looks like a heart monitor, up, down, wild swings. By evening, his confidence is gone, and he blames the market. In reality, he had no constitution, no law, no anchor. Now, picture another trader. She begins her day by reading her written laws taped beside her monitors. No candle close, no trade. Only London and New York sessions. Max 3 trades daily. Risk 2%. No trading within 30 minutes of major news. Exit immediately if setup invalidates. Each rule is clear, visible, and unbreakable. As the day unfolds, temptations appear. An open candle flashing green, an Asian session spike, a 4th trade whispering to be taken. But her rules shout louder. By following them, her results aren't perfect, but they are steady. Her equity curve slopes upward like a staircase, not a roller coaster. The revelation is simple. Freedom in trading doesn't come from doing whatever you feel. It comes from obedience to your own system. Rules are not chains, they are shields. Without them, you drift and drown. With them, you endure storms, survive losses, and capture gains. Tonight, create your trading constitution, not 20 rules. That overwhelms. 5 to 7 laws that target your biggest weaknesses. If you chase, write, I wait for candle close. If you overtrade, write, I stop after 3 trades. If you fight losses, write, I accept stops instantly. Print them, post them, follow them. Your survival, your consistency, your destiny depends on it. A trader without a journal is like a pilot flying blind through a thunderstorm. No instruments, no map, only instincts against chaos. He may sense turbulence, he may feel danger in his bones, but without records, he has no way of knowing if he's flying towards safety or into a mountain. In trading, timing mastery isn't just about reading charts. It's about reading yourself, your own hidden patterns that shape every decision. And the only mirror clear enough to reveal those truths is the journal. The journal isn't busy work. It isn't homework. It's your black box recorder. It tracks every entry, every exit, every emotion. Without it, you repeat the same mistakes endlessly, believing each loss is new, when in truth it's the same wound bleeding again and again. Dr. Brett Steenbarger once said self-analysis beats any technical indicator. Why? Because the market doesn't just move in patterns, you do. And those patterns either build profit or guarantee ruin. Picture two traders. The first closes another losing week. He shrugs, blames market conditions, and moves on without writing a single note. Weeks later, the same errors repeat. Premature entries, chasing moves, panicking at reversals. His equity curve looks like a roller coaster designed by his own forgetfulness. Without a journal, he is doomed to live the same week forever. The second, Elena Marquez, writes with precision. Each trade logged, entry time, session, pattern, risk, emotional state. She doesn't just track numbers, she tracks herself. At the end of the week, she studies her notes like a detective at a crime scene. And then the revelation hits. 80% of her losses come during lunch hour doldrums. 90% of her wins cluster around London Open. The journal didn't just record history, it uncovered her edge. Months later, her journal transforms again. She notices every profitable week has fewer than 10 trades. Every losing week has 20 or more. The lesson was hiding, in plain sight, invisible without the data. That discovery changes everything. The journal is your compass, your map, your teacher. Without it, you are blind. With it, you can see yourself clearly enough to change. Create one today, not tomorrow. A simple spreadsheet is enough. Date, time, session, setup, entry, exit, profit or loss, emotional state, notes. After 20 trades, sort them, search for patterns, learn who you really are as a trader, because the market already knows your weaknesses. The question is, will you discover them before it's too late? The market is never wrong. You can pour years into analysis, chart every candle, trust every instinct. But if the price moves against you, the market is right, and you are not. Every ruined account, every sleepless night, every desperate click comes from fighting this law. This is the humility principle. The market is bigger than your charts, bigger than your confidence, bigger than the stories you tell yourself about being skilled. Paul Tudor Jones once warned, "Don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good. The second you do, you're dead." Picture Daniel Cross, emboldened after a string of small wins. He sees a setup forming, one he believes in so completely that he sizes up, doubles down, refuses to yield. As price rises against him, he insists the market is wrong, that it will turn in his favor. But it doesn't. His stop-loss triggers, yet he removes it, convinced he cannot be wrong. Hours later, his account is obliterated, his pride scattered in ashes. Daniel wasn't destroyed by the market. He was destroyed by himself, his refusal to accept its verdict. Now, see Elena Marquez face the same setup. When the hourly candle closes against her, she doesn't argue. She doesn't hesitate. She exits immediately, a small loss logged with calm precision. The market has spoken. Days later, she finds another opportunity, this time aligned with time, momentum, and flow. She rides the wave smoothly, earning profit without struggle. The difference wasn't her analysis. It was her humility. She accepted reality while Daniel tried to rewrite it. The truth is brutal. Every loss is the market teaching you. Every win is the market testing you. That millionaire trader who once mentored me left me with his final lesson. The market is your teacher, not your enemy. Every loss is a message. Every win a question. Stay a student forever. So ask yourself honestly, how many times have you cursed the market, blaming it for your pain, when the truth was you ignored its signals? How much suffering have you invited by refusing to accept that the tide had turned? The sooner you accept the principle that the market is never wrong, the sooner you stop bleeding from the same wounds. Imagine that before every trade you whisper, I can be wrong, and being wrong is fine, if I manage it with humility. That mantra changes everything. Because when you finally embrace this truth, the battlefield dissolves into a classroom. Every candle is feedback. Every loss is tuition. Every win is a test of your discipline. The faster you stop fighting reality, the faster you begin evolving from amateur to professional. The tide is not yours to command, but you can learn to ride it. And when you do, the market ceases to be your executioner. It becomes your greatest teacher. A trader without a journal is like a pilot flying blind through a storm. You might feel the turbulence, sense the danger, even guess the direction. But without instruments, you are doomed to repeat the same crash again and again. In trading, timing mastery isn't just about understanding markets. It's about understanding yourself, your impulses, your habits, your hidden patterns. And the only way to reveal those patterns is through recording them. Your journal is not busy work. It is your black box recorder. It captures every decision, every hesitation, every moment of clarity or fear. Dr. Brett Steenbarger, author of The Daily Trading Coach, discovered that self-analysis beats any technical indicator. Why? Because while the market has patterns, you are the one executing. Your repeated mistakes, your emotional blind spots, your timing errors, they don't live on a chart. They live in your behavior. Journaling brings them into the light. Picture Alex Grant, a trader who never keeps records. He ends another losing week, shrugs, blames the market conditions, and moves on. Weeks later, the same setups fail him again. Same entries, same exits, same emotional spiral. His equity curve looks like a heartbeat monitor, spiking and collapsing without rhythm. Without a journal, Alex isn't just blind. He's trapped in an endless loop, repeating the same mistakes without ever seeing them. Now, look at Marilee, who journals with surgical precision. Every trade entry is logged with time, session, setup, emotional state, and notes. At the end of the week, she sorts the data and uncovers a shocking truth. 80% of her losses happen during low-volume lunch hours, while 90% of her wins cluster around London Open. The journal didn't just record her trades, it revealed her edge. With that insight, she adjusts her schedule, cuts the dead hours, and focuses on high-probability sessions. Her equity curve straightens, no longer chaos, but steady ascent. 6 months after my own mentor drilled this lesson into me, I reviewed my journal and found something humbling. Every profitable week had fewer than 10 trades. Every losing week had 20 or more. The pattern was glaring once written down, but invisible when I lived it day by day. That one discovery reshaped my trading forever. Without the journal, I'd still be stuck in self-deception. With it, I had clarity. The journal principle is simple. The market punishes forgetfulness. If you don't record, you don't learn. And if you don't learn, you repeat. Millionaire traders know this truth. Struggling traders ignore it. Your journal is not optional. It is survival. It is your map through the fog, your compass in chaos, your mirror when your ego blinds you. Start today, not tomorrow. Create a spreadsheet with these columns: date, time, session, setup type, entry price, exit price, profit, bar loss, emotional state, and notes. After 20 trades, sort them. Study the winners, study the losers. The hidden patterns you discover will be worth more than any course you could buy. Knowledge is power, but documented knowledge transforms you. Because the market won't stop testing you, but with a journal, you stop being the test subject. You become the scientist, and in that role, you finally step beyond survival and into mastery. There is one truth that echoes through every trading floor, whispered by legends and carved into the souls of survivors. The market is never wrong. It doesn't matter how perfect your analysis looks, how flawless your setup feels, or how strong your conviction is. If the price moves against you, the verdict is already in. The market is right and you are not. Every blown account, every shattered dream, every desperate revenge trade is born from ignoring this law. The humility principle is simple but brutal. The market is bigger than your ego, bigger than your desire to be right, bigger than all the technical books you've memorized. To fight it is to punch the ocean. Your fists only tire, the tide doesn't notice. But when you align with it, when you accept its verdict instead of resisting, you are carried by waves you could never create alone. Tudor Jones captured it best. Don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good. The second you do, you are dead. Those words aren't motivational slogans, they're survival instructions. Picture Daniel Cross, the stubborn trader who refuses to yield. He spots a pattern and believes in it so deeply that he doubles his position size. The market starts rising against him. "It's a fake out," he mutters, jaw clenched. Minutes later, it climbs higher. His stop-loss triggers, but instead of accepting defeat, he removes it and adds more to the position. The market can't be right. "I am," he insists. Pride whispers in his ear, drowning out reason. Hours later, the account is gone, reduced to digital ashes. Daniel wasn't destroyed by the chart. He was destroyed by his refusal to listen. Now contrast Elena Marquez. She sees the same setup, she commits, but when the candle closes against her, she doesn't argue. She doesn't widen her stop. She doesn't curse the chart. She exits instantly. The market has spoken. Her loss is small, controlled, logged in her journal. A few days later, momentum aligns, price and timing converge, and she enters again. This time, the market carries her trade smoothly into profit. Elena thrives not because she is always right, but because she accepts when she is wrong. My own mentor hammered this lesson into me after my first catastrophic loss. He looked me in the eye and said, "The market isn't your enemy. It's your teacher. Every candle is feedback. Every loss is a lesson. Every win is a test." At first, I resisted. My ego flared. How could I accept being wrong when I had worked so hard to be right? But over time, I realized he was right. The market is a mirror. It reflects my discipline, my patience, my humility. Ask yourself honestly, how many times have you blamed the market for your losses instead of taking responsibility? How often have you told yourself, "The market tricked me," when in truth, you tricked yourself by refusing to listen? Every time you deny the market's verdict, you deepen your wounds. Every time you accept it, you grow stronger.